So you want to start investing in stocks, but you feel totally clueless. And that's okay, because you are not alone. Let's discuss. So here's the truth. You don't need a finance degree. You just need to understand these three simple statements. They're called the financial statements. And yes, they might sound boring, but if you stick with me for a few minutes, you'll see how powerful they really are. You see, these three statements can tell you if a company is thriving or just pretending. Most beginner investors jump into stocks based on hype or someone's hot tip. But real investors, they look at numbers because numbers don't lie. When you know how to read a company's financials, you can actually make smarter decisions. So today I will break down the three main ones, which are the income statement, the balance sheet, and the cash flow statement. There's not going to be any jargon, just plain English. So let's dive in. First up is the income statement. This answers a basic question. Is the company making any money? It shows the company's performance over a period of time. For example, 3 months, 6 months, or a year. Remember, it has three main parts: revenue, expenses, and then profits or losses. Remember, revenue is the money which is coming in, while expenses is the cost of doing business. And when we take the expenses and subtract them from the revenues, we get profit or loss. Remember, profit or loss is also called net income or net loss. Here's a simple example. Let's say there's a bakery which is making $100,000 in sales or revenues. It spends about $70,000 in expenses, including things like ingredients, salaries, and rent. That leaves the company or the bakery with a profit of $30,000 per year. And that's the purpose of the income statement, to tell the investors if the company is profitable or not. Next, we have the balance sheet. This statement also answers another important question, which is, what does the company own and what does it owe? It's like a snapshot of a company's financial health at a specific point in time. The three main parts here are assets, liabilities, and equity. Assets are, of course, things which the company owns. For example, cash, inventory, building, machinery. Liabilities are things which the company owes to others. For example, loans, bills, or salaries due. And finally, we have equity, which is the difference between assets and liabilities. In other words, when you take the assets and from that you subtract the liabilities, you will come up with the equity. Remember, equity is what is left over for the owners of the company once everyone else has been paid off. So if the company owns a lot and owes little, that's a good sign. However, if the company is drowning in debt with very little assets, that's a red flag. And finally, we have the cash flow statement, which answers something which many people forget to ask, and that is the company generating any real cash? Because remember, a company might show profits on paper but still run out of cash. The cash flow statement is bifurcated into three sections. The first of these is cash flow from operating activities, the second is cash flow from investing activities, and finally we have the third, which is cash flow from financing activities. Cash flow from operations is the money which the company generates from its core operations. And finally, cash flow from financing includes things like taking loans or paying dividends. It's important to note that if the company is generating strong cash flow from operations, it's a very favorable sign for the company. On the other hand, if it's not, then even very big profits may be misleading. Because remember, you can't pay bills with accounting profits. For that, you need cash. Now let's recap quickly. The income statement shows the profits or losses that the company is making over a period of time. On the other hand, the balance sheet shows what the company owns and what it owes. And finally, the cash flow statement tells us if the company is generating any real cash. These three statements put together tells us the whole story, and not just how the company looks from the outside. It tells us what's really going on inside. Now here's what I want you to do. Pick one company and Google its financial statements, and then just read through them. And don't worry if you don't get it all, because every smart investor starts this way. You'll get better the more you look. If you like the video, give it a thumbs up because it really helps. and follow or subscribe for more beginner-friendly investing videos. And finally, drop a comment in the comment section below and tell me which financial statement would you like for me to break down in the next video. Thank you for watching, and remember that every great investor was once a beginner.